and welcome to the Look Forward podcast from S&P Global. I'm Aries Poon from Market Intelligence Division. I'm leading the analysis team for Asia Pacific and Latin America, and I'll be your host today. In today's rapidly shifting markets, success depends on anticipating what's next. The professionals who excel are those who can spot emerging trends before they fully materialize. The Look Forward podcast delivers exactly that insight to help you prepare for tomorrow's challenges and opportunities. We bring you expert perspectives on macroeconomic trends, capital markets, energy transition, and trade, with a sharp focus on what these developments mean for the decisions that will shape your tomorrow. This podcast connects you with S&P Global Look Forward Council, bringing cutting-edge research on long-term trends and transformative market shifts. Together, we are committed to providing you the forward-looking intelligence you need to navigate uncertainty with confidence. Today, we are looking at the macroeconomic consequences of the Middle East conflict, how geopolitical disruption shows up in growth, inflation, financial conditions, and central bank decisions. Our guest is Paul Gruenwald, Global Chief Economist from the Ratings Division. Paul, great to have you.
Likewise, Aries, great to be here.
So when you zoom out and think about the global economy this year and next year, what would be the single most important macro implication of the Middle East conflict?
Well, I think this is another example of a choke point, or sometimes we frame this as geoeconomics. This is countries using their leverage over either physical or financial choke points on the global economy to kind of get the outcomes they want. We saw this with trade. We saw this with strategic minerals. So it's really another step away from this Washington consensus world of free trade and free capital flows and general openness. So these kinds of choke points make the world more risky, more expensive, and slower growing. And I think this is the era we're in. And this closure of the Strait of Hormuz is just another example of that.
Actually, before the conflict escalated, the global outlook looked actually more supportive. So what has changed, and why does the war alter that balance?
That's right. When we were getting ready for our first quarter forecast on my team, we were talking about a number of tailwinds to the global growth story this year. We had the AI CapEx investment boom centered on the US. We had low energy prices. That's obviously not with us anymore. And we had relatively supportive financial conditions. And those have shifted to a more neutral stance. So we've gone from 3 potential tailwinds this year to kind of 1.5. And the way this came out in our forecast that we released last month was we framed it as the Middle East war shock neutralizing those tailwinds. So we took most of the uplift to growth off the table, and now we're characterizing the outlook as one where the downside risks to the baseline now predominate.
So let's get more precise on how the shock travels from the real economy into markets. I've heard you describing the economic impact of the conflict in 3 stages, right? Flow shock, supply shock, and market shock. And how should our audience think about the different channels through which this conflict hits the global economy?
Right. Well, just to be honest, that was not my characterization. I borrowed that from our colleagues at S&P Global Energy, but I found it extremely useful. So, as you said, the initial phase of this was a flow shock. That's when the strait was closed, but those initial ships and tankers got out. It took a couple of weeks, up to a month, to get to their destinations. So, markets were reflecting some turmoil, but the physical part of the crisis had yet to manifest. Once those ships reached the ports and there were no more ships coming because the strait remains closed, then we were getting into the supply shock phase of the crisis. That's where we are right now. And there it's really important to look across the economies and see which ones are energy producers. They're relatively in good shape. Which ones are energy importers with buffers? We know, for example, that China was building up its stocks in recent years. Japan and Korea have stocks as well. But there are a number of countries in this third group. I would say India, parts of South Asia, Philippines, Egypt, some African countries that really don't have many buffers at all. And that's where we're seeing the initial impact. So this is a supply shock. So the physical, quantum of molecules, as our friends in energy like to say, really matters. And that's where we're looking for the stress points right now. We think we're in that second phase still, in that supply shock phase. But as those buffers start to deteriorate, that's when we're in danger of going to a more dangerous phase.
So for business and financial market decision makers, like what signals would you tell them that pressures are, looking to shift into, say, the market shock phase or a more destabilizing phase?
Right, that's the big question, right? We're still in oil prices around 100 plus or minus per barrel, so it is definitely higher than it was earlier in the year when we were around 60. But in real terms, it's not as bad as say where it was in 2008. So we're actually looking closely at the stock dynamics. We know that those stocks can't last forever. We're looking at the spot prices for Brent and others. Those are spiking in places like Oman, but not entirely clear when we enter that final phase. But that's a phase where markets would reprice the global growth outlook, where the supply shock really starts to bite, and then we would get more broad-based macro effects beside or in addition to the physical effects. And then you would get a marking down of growth, probably some equity market stress. You'd get a wealth effect. You get volatility, flight to quality, the usual type of things we see. That's not out of the realm of possibilities, but we probably have a bit further to go until we get into that scenario. But the key variable to watch there is these buffer stocks that many of the economies are now using to shield their population from the effects of the Middle East crisis.
Yes, and when you talk about buffer stocks, that leads us naturally to energy because it changes the whole inflation versus growth calculus. So how is an energy-driven shock fundamentally different from other types of shocks, say, driven by trade or other policies that we've seen in recent years? And why does that matter for inflation and growth dynamics?
Yeah, well, first of all, this is a supply shock, and we know that supply shocks are different than demand shocks. In a supply shock, prices tend to go up and output tends to go down. That's a problem for central banks. I think we're going to talk about that later. But again, this is really about kind of the molecules, the oil and gas molecules being trapped in the Gulf. And I think we probably pay insufficient attention to energy flows when we're thinking about macro. So you mentioned the tariffs last year, and those are changing relative prices, and we can think of supply chains adjusting and production adjusting, etc. But there's really no disruption into a fundamental input for economic activity. That's what we're seeing right now, and that's why this particular shock is different and much more challenging for firms, businesses, and policymakers.
And in this kind of environment, how does the burden of energy price rises get distributed across economies and sectors?
That is actually a super interesting question because we know the price of energy has risen, but the question is what's the incidence of that? It's a little bit like the tariff question we were asking last year. Who's ultimately paying for these higher oil prices? And we have three candidates here. First, the government can absorb the higher prices and not pass them on to firms and consumers. So that's going to put pressure, obviously, on the government's balance sheet, and all else equal implies they'll need to issue more debt to finance their operation. We could also have margin compression. We can imagine a situation where there's a state-owned or state-controlled oil firm, and they are, incentivized or orders to, not increase prices and maybe compress their margins to lower levels than they would normally be. Or we could pass the higher prices straight on to consumers. We're seeing that in the U.S. We're seeing more of the fiscalization in Asia, and then some intermediate cases in between. But it really helps to think about where it's showing up in the system. We don't get stuff for free in economics, so it has to show up somewhere between fiscal pressure, margin compression, and higher prices for firms and consumers in the end.
Great. Let's zoom out again a little bit because I've also heard you describing the global economy as unusually unsynchronized. And how does this conflict amplify those differences across major economies, say the US, Europe, and China?
Right. Well, we like that's those are the three economies we typically focus on at the beginning of our forecasting round, and when we do our macro surveillance. Sometimes those macro stories are more or less aligned. They're very unaligned right now. I think the energy shock amplifies this because the U.S., as we know, is a net producer, a net exporter of energy. So these countries will definitely see some benefit from the crisis. These are globally traded goods and global prices, so energy costs are going up here in the U.S. But firms who produce this are seeing windfall profits, and the U.S. has been able to export into higher prices as well. China, as we mentioned, has been building up buffer stocks over recent years. They look at least relatively well insulated in the short term, and not everything's passing on to final consumers. And Europe's a little bit of a mix in between, maybe more exposed to gas than oil, but we had a relatively unsynchronized configuration of global growth going into this crisis. And as you mentioned, Aries, the energy shock has actually amplified that.
So, what does that divergence you talked about imply for coordination among policymakers, or maybe the lack of coordination among policymakers?
Yeah, well, we did see that. We did see the release from the IEA, the International Energy Association, for the for the release of strategic oil stocks. That wasn't very large in the grand scheme of things, and we see a lot of self-insurance. Again, China, Japan, and Korea maybe being good examples of that. So the coordinating mechanism is actually the price. We don't have a an international monetary fund for energy that countries can draw on, and stocks are going to help us through all of this. But this is a new shock. The strait has never been closed before, and we haven't had something like this since the 1970s. So I think when this is over, we're going to have some conversations at the international level. I can imagine countries will be building up more of their energy stocks, building more redundancy and cost into the system. But we're a little bit in uncharted waters in terms of global coordination for a physical energy shock. So we will be watching how that plays out in the coming months.
Thanks, Paul. And let's close today's session with a look at where the constraints can bite hardest. So we're talking about emerging markets, Asia, and central banks. So overall, where do you see the economic stress accumulating most acutely as this plays out?
Yeah, well, as we hinted at earlier, the stress is going to be energy importing countries that do not have a lot of buffer stocks. So they will be forced to go into the market and buy at the spot price, which is sometimes significantly higher than what we're seeing in the benchmarks like the Brent and WTI. If we do not get more supply onto the market, we will have to have what we call demand compression. So if supply cannot rise, because molecules are bottled up in the strait, demand will have to fall. And the way demand falls in this scenario is through demand destruction via the price channel. So prices go up, and demand falls, growth falls, industrial output falls, and the countries that are not insulated against that, again, the ones who don't have buffer stocks, don't produce, and have to go into the spot market, those are the ones most at risk.
One final question. So, how are central banks navigating this mix of geopolitical risk, inflation pressure, and uneven growth?
Supply shocks are tough for central banks, right? Because inflation tends to go up and output tends to go down, which would put downward pressure on inflation. So there are mixed signals. It's pretty clear right now that central banks are in a wait and see hold and kind of leaning higher. If it's a pure supply shock, central banks, or at least credible central banks, should be able to look through this. A credible central bank is one that has established its ability to deliver its inflation target. And in those countries, you would see inflation expectations over the medium term relatively well anchored. So the price shock, the price jump can work through the system and then kind of fade out as the shock winds down. What we've seen right now is central banks have definitely stopped cutting rates. Most of them are on hold, and they're kind of what we call hawkish holds. They're leaning higher, signaling that if this price shock lasts for longer, and if the inflation starts to spill into everyday wages and prices, what we call second round effects, then central banks may need to tighten. But it's a tough situation, and growth and inflation are going in different directions. But I suspect we're probably going to see a few central bank hikes before we get back to the end of the cutting cycle, which is where we were when all of this started earlier this year.
Paul, thank you so much for helping us frame what really matters
My
as this
pleasure.
plays out. And I can tell the key message today is the conflict pushes risk toward higher for longer inflation, complicates growth, and does so through energy and supply channels that are much harder to offset. And all of this is landing on an already unsynchronized global economy, making policy trade-offs sharper and coordination harder. If you would like to dive deeper into our research and our blog posts, visit spglobal.com and explore our Look Forward Council resources. You can also connect with Paul on LinkedIn. Thank you so much for listening to the Look Forward podcast. If you enjoyed this episode, please subscribe to Apple Podcasts, Spotify, or YouTube, and we'll see you next time.